Have you ever felt like your money problems don't just add up, they explode? This video explains why. Because being broke doesn't just mean having less money. It means everything costs more, not eventually. Not metaphorically, mathematically. Let me show you. Imagine you're driving to work. You're already running late. Then the check engine light turns on. Your stomach just drops. You know that fixing it right now might cost about $300. But you check your bank account, and you see you've only got $42 until payday. So, you ignore it. You turn the radio up a little louder. You tell yourself you'll deal with it later. 2 months go by. The car dies on the highway. Now you need a tow. That's $200. The original problem, the one you ignored, has now damaged something much bigger. The repair is now $2,000. On top of that, you miss a few days of work because you can't get there. That's another $300 gone. That original $300 problem has spiraled into a $2,500 disaster. That isn't just bad luck. That is the very real cost of not having money when you need it. It's a penalty you pay for being broke. Welcome to the Financial Sketchpad. We're the channel that breaks down confusing money decisions using simple sketches, real numbers, and clear thinking. If you feel like you're working harder every single year but never seem to get ahead, or if it feels like one bad week could wreck everything you've built, then this video is for you. Because today, we're talking about why being broke is the most expensive financial position you can possibly be in. Most financial advice assumes that poverty comes from bad habits or poor choices, but there's a much deeper problem at play. It's a concept called the boots theory. Imagine two people. One person can afford a $50 pair of high-quality boots. They're well-made and they last for 10 years. Another person can only afford $10 boots. They're not great quality, so they only last for 1 year. Over the course of 10 years, the first person spends $50. The second person, buying new boots every year, spends $100. They both have the same need keeping their feet dry, but one pays double the cost. That's the math of being broke. You pay a penalty for not having enough upfront capital to buy the better, more durable option. This isn't just about boots. This poverty premium shows up everywhere. Take toilet paper, for example. If you have $50 to spare, you can go to a warehouse store and buy in bulk. You might pay 50 cents per roll. But if you're living paycheck to paycheck, you can only afford the small 4-pack from the corner store. That might cost you $1.50 per roll. It's the exact same product, but you're paying 3 times the price. This applies to groceries, diapers, cleaning supplies, almost every essential item you buy. If you're broke, your personal inflation rate is actually higher than a wealthy person's. You're paying more for the exact same things, simply because you can't afford to buy in larger, more economical quantities. And the banks? They often make this situation even worse. If you have money in your account, you typically get benefits like no fees and preferential treatment. But if you don't have money, the system works against you. Let's say a $25 charge hits your account when you only have a $20 balance. You are now negative $5. What does the bank do? They often charge a $35 overdraft fee. You effectively borrowed $5 and paid $35 for the privilege. That's not a mistake. For many banks, it's a core part of their business model. The rich earn interest on their savings, while the poor pay interest on their debt and fees on their lack of funds. This constant financial stress also changes how your brain works. Scientific studies show that dealing with scarcity reduces your cognitive capacity. It's similar to the mental fog you experience after missing a full night of sleep. When your mind is completely occupied with immediate survival, how to pay for food, how to keep the lights on, long-term planning becomes almost impossible. This is why people sometimes take out high-interest payday loans or pay extra for convenience. It's not because they're being irresponsible. It's because their mental bandwidth is completely overloaded. Their brain is focused on solving the immediate crisis, not optimizing for the future. Cars make this painfully obvious. Let's call it the buy nice or buy twice principle, but with a twist. A person with savings can afford to buy a reliable, certified used car. They get a low-interest loan and experience relatively low stress. But a person without savings often has to go to a buy here, pay here lot. They end up with an overpriced, less reliable car and a sky-high interest rate. They'd pay more upfront, more in interest, and the car is more likely to break down sooner, trapping them in a cycle of repairs and debt. They aren't just paying for transportation. They're paying a risk tax for not having a financial cushion. Housing is the biggest and most challenging version of this entire problem. In most places, renters pay more per month for their housing than homeowners do for their mortgage. But unlike a homeowner, a renter gains zero equity. Their monthly payment disappears forever. Of course, buying a home requires a down payment and good credit. Building up those savings is nearly impossible when rent is already eating half your income. So the system creates a loop. You rent your shelter. You rent your money through interest on loans and credit cards. You are, in effect, renting your own stability, always paying a premium for not owning your assets. So what's the solution? Here's the critical mindset shift. If you're broke, the primary goal isn't to get rich. It's to stop the bleeding. It's to escape the penalties. Paying off high-interest debt is a guaranteed financial return. Fixing that check engine light early is an investment in preventing a future disaster. This is precisely why an emergency fund is so powerful. That first $1,000 you save changes everything. It's a buffer. It transforms potential financial disasters into mere inconveniences. The car repair is still annoying, but it doesn't cause you to lose your job. When you finally have a little extra money, the natural instinct is to treat yourself. And that's completely understandable after so much stress and sacrifice. But the smarter, more powerful move is to use that money to solve problems permanently. Buy the more reliable tires that won't go flat on the highway. Go for that preventative healthcare checkup. Fix the small leak before it floods the whole room. You aren't just spending money. You are strategically buying back your future. You are removing future costs and future stress from your life. Being broke is not a personal failure. It's a mathematical penalty that compounds over time. It's a tax on not having enough. But once you see the math, you can stop blaming yourself and start attacking the penalties instead. Build the buffer. Prioritize paying down high-interest debt. Make choices that lower the lifetime cost of your life, not just the immediate one. That is how you escape the cycle. That is how you start winning. This is the Financial Sketchpad. Thanks for watching.